What's going on, guys? My name is Lior and welcome back to my channel. Now, what I thought I would do in this video is talk about the last R in the BRRRR strategy, which is refinance, right? There's a lot of content out there all about the different parts of the strategy, especially mainly focused on the buying, the rehabbing, the renting, right? But I don't think there's as much stuff out there about refinancing. And there are a couple of key components that I think you absolutely need to think about up front as you're going through the process of the execution of the project, right? I'm actually doing a couple of cash out refinances now on my own BRRRR projects, and I'll talk to you guys about three key components that I've seen over and over again as I've gone through the process that I think you absolutely need to think about up front. So with that, let's get at it. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, two super quick things. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I put out tons of new content every single week talking all about rental property investing. I give you guys tours of my projects. I show you guys, I share tips and strategies and literally everything in between. So if that's the kind of content you're looking for, make sure you subscribe. So let's get right into it. And as I said, I am going to be talking about the refinance aspect of the BRRRR strategy, right? Made famous by Bigger Pockets. Now, again, the reason I'm doing this is I am going through a number of cash out refinances as we speak. And I've kind of noticed a couple of trends that I think if you don't think about upfront can hurt you on the back end of the project. So let's get right into them, starting with number one, which is going to be especially relevant for those of you guys doing the BRRRR strategy with multifamily. And that is that before you close on a cash out refinance, you at minimum need to have leases in place and signed, right? And what I mean by that is this, right? So I am going through a couple of cash outs, and on all my cash outs, right, the lenders that are doing the mortgages for the new loan are asking that I at least have signed leases in place, right? They're not necessarily insisting that tenants have moved in by the time we close on the loan, but they want to see all signed leases for all of the units before we close on the refinance. Now, this is kind of logical, right? Because if you're going to be doing a cash out on rental property, you should have leases and tenants in place. But this can be a little tricky, right? Especially if you're on a tight timeline, right? A lot of us that are financing our projects, especially on the front end, are usually using short-term money or bridge money. That could be hard money notes, right? Which are expensive and usually have a specified term. So depending on how your project is going and what your timeline's looking, this could actually have quite a bit of an impact, right? Because let's say you only have a couple of months left on your hard money note and you're still going through construction, you need to start lining up the back end refinance. But again, you can't close on that back end refinance until you have those leases in place, right? And it's hard to get those leases in place until you have your construction done, right? So it all kind of stems from each other. So make sure that as you're thinking through timeline, as you're thinking about terms for your first acquisition mortgage, right? However you structure that, make sure you kind of think about that. And this is actually even more critical for those of us up in more cyclical markets. Like myself, I'm in Boston. That's where all my projects are. So for example, if I'm finishing up a construction project, let's say in the fall or winter, right? Typically the rental markets are much, much slower during that time. So it's going to take me an extra 30 or 60 days to even find tenants to apply to the unit and potentially put a lease in place, right? So these, again, having that kind of delay of 30 to 60 days could potentially mess with you, especially if you're on short, predefined terms of expensive money, that may not be so easy to extend or get extensions on, right? So make sure you keep that in mind. Number two tip I have for you guys, especially when you're doing your numbers on the front end and when you're looking at buying a project, is you have to look at the back end debt service coverage ratio, or DSCR. Now, if you don't know what DSCR is, I'm going to define that in 1 second, but this is mainly prevalent for those of you guys that are going to be refinancing into a commercial note on the back end, right? And most of us are refinancing into commercial loans on the back end, right? Because most of us are buying property that needs the renovation work through an LLC, right? Because we are using commercial notes on the front end, whether it's a local bank, a hard money note, or whatever it is. So typically when you buy your property with an LLC up front, when you're doing the cash out refinance, you're probably going to be looking at commercial lenders to do that cash out mortgage for you. So what is a DSCR and why do they care about it? So if you don't know this, make sure you study this up. But basically, DSCR is the ratio of your net operating income for the property, right? Which is just your gross income minus your gross operating expenses, not including the mortgage payment. And you divide that by the actual mortgage payment, right? So it's basically a percentage of by what factor is your net operating income greater than the mortgage that's going to be due when you get this brand new cashed out refinance mortgage, right? So the reason lenders want to evaluate that is because they want to see just by how much you're going to be able to cover their mortgage if you're going to be essentially like scrambling every month, right? Now, typically, at least in Boston, the lenders I deal with want to see a ratio of 1.2 or higher. So the implication this has for you, and this is critical, right, is let's say you were thinking about doing that cash out refinance mortgage, right? And let's use easy numbers, right? Let's say your property is worth $1 million once it's renovated. You're thinking about doing a 75% loan to value cash out refinance, which means you would get a new mortgage of $750,000 on the property, right? Well, that's all fantastic, assuming that with that new monthly mortgage payment on that $750,000 mortgage, you are covering your debt service, right? With that 1.2 ratio or greater. Now, if you're not, right, what the lender most likely is going to tell you is, hey, there's not enough income to support this kind of debt on the property. We're going to have to lower your loan to value, right? So instead of a 75% loan to value cash out, you might be only limited to, let's say, a 70% cash out or a 65% cash out, right? Because now your mortgage payment becomes smaller since you're taking a smaller loan, and there's a better chance that your net operating income divided by your mortgage payment is going to hit that 1.2 number. So as you can see, this has huge implications, right? Because now all of a sudden you're lowering the amount of money you can cash out on the back end. And if you borrowed, if you structure your deals like I do, right, where I have I usually do some sort of primary acquisition mortgage on the front, plus I'll usually partner with private investors, right, on the front end and cash them out on the back end, right? If you all of a sudden you're limited by how much money you can pull out from the bank, that's trouble, right? Because that might hinder the amount of money you can repay back to the bank or to your private investor. So this has really, really key implications, and I see a lot of people really missing the step, right? So make sure you look this up, make sure you study up debt service coverage ratio, and play around with the numbers. Understand that if you're not gonna hit that debt service ratio, right, you might be limited on how much money you can pull out on the cash out on the back end. And again, you don't wanna be in a position where you didn't analyze this and all of a sudden you can't pull out the amount of money that you thought you wanted to or needed to. And finally, my tip number 3 for you guys on the refinance is evaluate different terms from different banks. And what I mean by that is I've done a number of cash outs at this point, and I've been able to structure my cash outs with various terms, right? There's been some properties where I did a cash out mortgage that basically became a regular 30-year amortizing commercial mortgage, right? So kind of like your standard residential loan, it's a 30-year term with a 30-year amortization period, which makes the calculation nice and easy. But there's also been some instances where I've done cash out refinances and I've been able to structure it a little bit more creatively. Twice I've been able to get interest-only periods on the first year, right? So basically on that new cash out loan mortgage, for that first 12 months, I didn't have to make a principal payment. I only had to make an interest payment. Now the advantage to me obviously is I get a lot more cash flow, right? My monthly payments are much lower. I don't have to pay back principal for the first 12 months. So for that first 12 months, I'm really, really raking it in with the cash flow. Now, this obviously you're not paying down your principal. So this kind of depends on your business plan for the property, right? Are you looking to maximize cash flows up front and maybe sell off the property in a year or two? Are you looking to hold it long term and try to pay off that mortgage on it as soon as possible, right? So it kind of depends on what you're looking to do with the property, what your strategy is. But just understand that there's multiple ways to structure even that back-end mortgage on your refinance, right? You're not just limited to one sort of way. So make sure you talk to different banks, different lenders, and really get the best possible mortgage that makes the most amount of sense for you, the property, and your business plan. So hopefully that helps, guys. I know I kind of went a little bit in the weeds of the details here, but those are 3 absolutely critical things I would definitely think about on the front end. If I was going to jump into a BRRRR project, right, you really want to figure out exactly how you're going to refinance and what your exit is on that property. So if you have any questions, any concerns about any of that, make sure you put it in the comments below, and I will definitely help you out.